Following on from last month, the same themes have continued to impact global markets through May. These are elevated volatility, inflation, and the near-term direction of interest rates in the major economies. The ongoing war in Ukraine, China's COVID lockdowns, and increased monetary tightening by global central banks remain the biggest drags on sentiment. So starting with volatility, and we'll use the UK's leading index as an example, we've seen several 100-point swings over the month, but actually the index is trading back around where it started. The other key point to focus on right now is inflation. In an effort to combat inflation, the US Federal Reserve raised interest rates by 50 basis points at their May meeting. Now this makes it the largest single hike since 2000. A tight labour market and persistent inflation continue to reinforce the market belief that the Fed will hike rates aggressively again this year. So let's keep that inflation story. And UK inflation soared by 9% in April, and that's the highest level for more than 40 years, as the rising cost of gas and electricity pushed the number higher as part of this cost of living crisis that we're facing. So what does this all mean for growth assets? Well, US markets fell as tightening financial conditions began to drain liquidity and drag down equities. Tech stocks in particular felt some pain. Rising interest rates have put more pressure on growth companies as they now need to become profitable more quickly. So against this backdrop of lower growth and higher inflation, there are certain industrial sectors that have traditionally proven to be more defensive in these conditions. Now these include consumer staples, and these are companies that produce goods that are always in demand, healthcare and energy. In terms of factor performance so far in May, value and small cap have been the best performers. Quality and growth have lagged in the short term. Turning to defensive assets, well, perhaps surprisingly, UK Treasury 10-year prices have consolidated and equivalent US Treasuries have actually increased in price. Now this is reflecting the market forward pricing the extent of current rate increases. So in summary, the key themes affecting the market appear to be the same. Interest rates, the direction of inflation, and of course, volatility. And it seems in the short term, volatility is here to stay.